A tale of two oil giants. Saudi Aramco successfully lists in Riyadh while Chevron takes a $10 billion write-down. Europe gears up to battle climate. New European Commission President Ursula von der Leyen unveils aggressive climate goals. Now the hard work begins. To flare or not to flare? I sit down with Ryan Sinton, Texas Railroad Commissioner, about ways to deal with an abundance of natural gas, from building pipelines to flaring. I'm Alix. Welcome to Bloomberg Commodities Edge. It's 30 minutes focused on the companies, the physical assets, and the trading behind the hottest commodities with the smartest voices in the business. First, we kick it off with Spot On. It's our take on the big story, and today it's a tale of two oil companies, Saudi Aramco and Chevron. Joining me is Tina Davis, Bloomberg Managing Editor of Energy and Commodities, and Rachel Adam Hurd in Houston. Let's kick it off with Aramco, touching a $2 trillion valuation on Thursday. When are we going to get to know the real market value of this company, Tina?
Well, we have a better indication now, right? We've had 2 full days of trading now. The first day they went up by their limit, by the daily limit of 10%. That's encouraging. And then today they went up about 5%. But as you mentioned, for a few brief hours, they were trading at that magical $2 trillion level, which, as we know and as you've reported, is the level that the Saudi Crown Prince was looking for. We initially floated the idea of a Saudi Aramco IPO. And so where do we go from here? So we've had investors who've told us we think this thing will increase by another 10 to 18% in the next week. But on the other hand, we've also got a note today from Sanford Bernstein saying, get out, that it's time to sell already. So opinions are all over the place at this point.
But considering the difficulty that the Crown Prince had even bringing it close to a $2 trillion valuation, it's hard to underwrite the fact that he actually got there. Does this do anything for international listing? When do we get a read on that?
Well, I think, there was a pullback, and it became very much a local effort. You see a lot of local money in this, so it sort of defeats the purpose of trying to defray some of the liability and inject new money into Saudi Arabia that's not oil related, because again, you're having a lot of your own investors within the kingdom put their money into essentially an oil bet. So it's not really accomplishing everything that the Crown Prince set out to accomplish by way of diversifying the economy. Mm-hmm. I think that is still an effort that's ongoing, and I think what they've done is they've gone above and beyond to make this listing in Riyadh become incredibly successful so that there is a chance to potentially look at international.
All right, Tina Davis, good stuff. On the flip side, though, you got Chevron taking a huge write-down of as much as $11 billion, primarily due to its natural gas assets. I'm joined by Rachel Adams Hurd in Houston. Hey, Rachel, can you put this write-down into perspective for us, this huge write-down?
Yeah, it's pretty big. I mean, you saw the majors go big on gas, and so far for Chevron, that's been an $11 billion headache. But I think if you've been paying attention at all to U.S. gas prices and difficulty building pipelines out of Appalachia, you wouldn't be surprised just by how hard Chevron's been hit. I think it'll be interesting to really watch what happens to a lot of the independent producers in that area that don't have the balance sheet of Chevron, that don't have diversified assets, because you've seen with Chesapeake and the going concern warning that it flagged last month that these guys have seen better days, and it's just a really tough environment for U.S. gas producers.
Yeah, that definitely was the rhetoric, sort of who is next, what about the bankruptcies, and also really shown this huge spotlight on Exxon that bought XTO for $42 billion, and it's only taken a $2.5 billion write-down. Any read on where that stands?
Yeah, I think you kind of saw a mix of opinions. On the one hand, Exxon tends to take a bigger view, a more forward-looking view, or encompass a bigger future than Chevron does, and they're kind of known for that. So maybe they don't have to take as big a write-down as Chevron does. But on the other hand, you had Paul Sankey at Mizuho saying, okay, Exxon, what about you? What about XTO?
Exactly. What was also interesting is that in all of this, the CapEx plans were released. They're on the higher end. In particular, Permian investments are going to be about 10% higher next year to about $4 billion. But along with Permian oil production comes natural gas, which weighs on prices, which then hurts its other assets. It's this like vicious catch-22.
Definitely, yeah. And I mean, especially in the Permian, you're seeing companies say, okay, I have way too much gas. I don't know what to do with it. I can't connect to a pipeline. Kinder Morgan's pipeline that was supposed to be the next step on the docket is delayed because of opposition in Central Texas. So it's not a pretty picture for gas outlook if you have too much of it in the U.S.
All right, thanks so much, Bloomberg's Rachel Adams Hurd. Thank you. And as we head to break, Goldman's Jeff Curry weighed in on where he sees gold in 2020.
when we look at de-dollarization in central banks, in fact, I just got the stat from speaking on radio. De-dollarization, the demand from central banks globally for gold this year is as big as the Nixon era.
Wow.
They're eating up 20% of global supplies. Our estimates, we did 750 tons, that's our base case, of central bank buying. So de-dollarization is why I'm going to like gold better than bonds, is because the bonds won't reflect that de-dollarization.
I'm Alix. This is Bloomberg Commodities Edge. Time now for the Data Dig, where we delve deep into the market trends of the week. So first up, you got the oil inventory numbers. You saw a surprise build. It was small, but it was a surprise. Most of the decline was actually in the Midwest, but that was offset by higher Gulf Coast stocks of over 5 million barrels. Pad 1, though, I should point out, stocks there the lowest since October of 2014. And palladium surged to a record this week, topping $1,900 an ounce. You got South African mining companies halted operations in response to the country's power cuts. Now, Citi says palladium could go over $2,500 over the next 6 to 12 months. And in the ag market, the wheat price got a nice big pop on some trade optimism, but it was the supply and demand picture that was also quite interesting. The French crop will see the lowest reserves in about 6 years. All of that's on stronger demand. Exports are the highest in about 7 years. And now, let's get into the ring. It's flaring versus the climate. Shale producers in Texas are getting more than 40 times as many permits for venting natural gas as they did at the start of the supply boom a decade ago. I sat down with the man responsible for those permits, Ryan Sitton, head of the Texas Railroad Commission.
I think we'll probably sustain, in other words, we'll continue to grant flaring permits because we continue to see development. However, you'll see a big drop in the rate. So there is a lot less development going on with oil prices being down, less investment in the oil business, and a lot of oil producers are trying to operate within cash flow. So because of that lower amount of development, we'll see less permits.
Do you think that means that rigs are going to start getting shut down, or does it mean that just new investment is not going to come on?
Rigs are already coming off the market. If you look over the last year, especially over the last 6 months, the number of rigs operating in the United States and Texas has dropped by about 200, or call it 15%.
Do you feel, though, if oil prices stay above 60 or they get to 60 around those, does it change? Do you feel like we're going to have a very quick market reaction?
Well, two things have to change. One is that oil prices do need to come up, and I think we'll see that. Over the next couple of years, it wouldn't surprise me to see $70 a barrel again. However, we also, as I said, are seeing a lot less capital infused into the oil and gas market. So companies are getting their balance sheets changed, and as a result, even with higher oil prices, there's not as much capital to invest, so less drilling operations will go on.
Have you ever rejected a flaring request?
Yes. However, the important part is to understand that you won't see that in the data, because when we reject them, usually that means that the producers see that something is wrong with their permit and they withdraw them before we ever get to a hearing process. Mm-hmm. So if you look at the data, you say there's none have been formally rejected, yes, but a lot have been withdrawn.
I guess I just get confused because the rhetoric, I think 6 months ago, was that the pipelines were going to come on and it was going to solve everyone's problem in the Permian. Like, what didn't happen to make that thesis work?
Well, we're still waiting on one big pipeline. So
okay.
One, the Gulf Coast Express came on, which this past September put 2 billion cubic feet a day of gas capture in place, and another 2 billion cubic foot a day pipeline is coming on end of next year, and that'll solve another problem. But the recent rhetoric has been all around one specific case, and this is something I hope we get to talk about, which is this one permit where a producer was connected to a gathering system that caused a lot of confusion and signaled something to the market that wasn't accurate.
Mm-hmm. Right, so let's talk about that, because
okay.
you're talking about Exco
yes.
is hooked up but not have a contract with Williams, and
yes.
then Williams is suing you guys, saying that you're letting them flare, but you're not requiring them to connect to our pipeline, and that's a bad thing. So what's your response?
Yeah, we are not allowing them to, we're not forcing them to use the pipeline operator, because in the case that came before us was one of two cases. The second one we haven't heard yet. The first one was, you shouldn't allow them to flare. Well, in the case that we heard, the pipeline company was asking for rates that were 10 times the market price for gas. Mm-hmm. And the fact was, they had a big disagreement going on in terms of what rates they should be paying. In the meantime, we weren't going to force a producer to pay exorbitant rates. At the same time, there's another case we already have that we haven't heard yet that is evaluating the rates that they should be paying. And so all we did was grant a permit for 7 months to allow the producer to continue to flare while we're trying to work this out, instead of telling the producer you either have to pay these exorbitant rates or shut down. Now, that's a very unique case that we almost never see.
Do you feel like you need to, though, walking it forward, consider other things when you wind up declaring yes for a permit or dealing with pipeline takeaway capacity, like climate issues, other stuff, like different requirements?
Well, on a macro scale, we do consider those things. So, for example, people have asked a lot about what about the amount of CO2 being produced? Well, look, in the state of Texas, we're producing we're flaring, call it 2% of the gas that we produce in the state right now. I mean, that's a pretty small number compared to, 50 years ago, the state was flaring 40% of the gas we produce. Just in North Dakota in 2014 and 2015, they were flaring as much as 20% of their associated gas. Look at places like Russia, where they're flaring in the double digits at least. So Texas has actually a very low percentage of its flaring, of its gas that's flared. And so the result is, if we produce more gas in Texas, that's a lot lower percentage of the gas that is actually flared.
What do you say to a company that's like, hey, I wound up connecting to this pipeline, I paid this rate, and you're going to let X go just flare and not have to deal with that? And what do you say to that pushback?
Well, most of the time when companies agree to pay a rate, they do it as the pipeline's being connected. So that they agree to that rate before they ever get involved in that specific connection. It's very rare that you have this situation where the pipeline company was already connected and then they were trying to do a new rate. It was because the company that the producer had bought the wells from had gone bankrupt. And so this was a really unique case that almost never happens.
That was my interview with Texas Railroad Commissioner Ryan Sitton. And it is the end of an era. Billionaire wildcatter Harold Hamm announcing that he will step down as chief executive of Continental Resources, a shale oil producer he founded over 50 years ago. Now, beginning January 1st, Hamm will become Continental's executive chairman, and he will be replaced as CEO by William Berry, the former ConocoPhillips executive and Continental board member. Now, Hamm, who once called OPEC a, quote, toothless tiger, said in a statement, "I'm not going anywhere. I'm an oil finder and geologist at heart. I have a long history of buying, not selling our stock, and that will not change." To me, that means Hamm is still going to get his hands dirty and he will still want to be drilling for oil. Well, coming up, the business of brewing beans. We're talking coffee. That's coming up next on Bloomberg Commodities Edge.
The European Green Deal is our new growth strategy. It's a strategy for growth that gives more back than it takes away. And we want to really make things different. We want to be the front runners in climate-friendly industries, in clean technologies, in green financing. But we also have to be sure that no one is left behind.
That was Ursula von der Leyen's monumental green moment. The European Commission unveiled aggressive climate targets that they'll be carbon neutral by 2050, and they raised their 2030 reduction target to as much as 55%. The big question, though, is how much money is this going to take? Well, Bloomberg Economics may have an answer. So according to its analysis, it's going to take a 1970s style investment, including additional investment of almost 2.5% of GDP, which amounts to about 400 billion euros a year, and a 10 to 15% increase in overall investment over the next 30 years. It will rely heavily on private funding, and maybe fiscal rules could even be revised to make room for this green investment. So speaking of, it is time for the BNEF Brief, which gives in-depth analysis on clean energy, advanced technologies, and transport and commodities. BloombergNEF just issued Climate Scope and found that clean energy investment stalwarts like Brazil, Turkey, and India are actually seeing investments fall. Joining me now is Luisa de Moro from BloombergNEF in Sao Paulo. So, Luisa, when you take a look at that, what does that tell you about who's leading in this clean energy investment?
Hi, Alix. So you're right. Peaks in clean energy investment have actually shifted from traditional winners to less mature markets. Overall investment numbers have dropped by a lot, and this has a lot to do with the fact that giants like China, India, and Brazil saw investment numbers drop. China is, of course, the main country to blame, as the country alone saw investments dip by $36 billion. But we also see really exciting news for new markets. This is the case, for example, of Vietnam, Argentina, and Ukraine, which saw in 2018 record investment levels.
Yeah, you mentioned, we have a chart that shows sort of Vietnam and how much the investment's gone up. Is that a fair thing to look at, considering like the comps are going to be so low, and or what's driving that kind of investment? So
Vietnam is a really remarkable market to look at, as investment have jumped about tenfold from 2017 to 2018, reaching about $6 billion. This was mainly driven by a feed-in tariff, so what premium paid on clean energy contracts that made especially the solar market attractive for developers and for investors.
I'm glad you mentioned developers. Like, who's footing the bill for all of this?
So when we look at emerging markets in general, most of the capital is actually coming from local sources, but this is mainly because of China and Brazil that rely a lot on domestic players. However, something interesting is that last year we saw foreign investment for clean energy projects peaking in emerging markets with $24 billion. If we look at who is actually putting the money, Enel is the top one investor, the Italian utility Enel, not only in 2018, but also in the decade. Over the past 10 years, Enel has invested $7.6 billion in clean energy projects around emerging markets, most of it in Latin American nations such as Chile, Brazil, and Mexico, and about $2 billion in 2018 alone. And among the top 5 for 2018, we also have Actis and the French utility ENGIE.
All right, Luisa De Moro of BloombergNEF, thank you so much. I appreciate that. Let's turn now to Commodity in Chief, where we focus on one executive in the commodity world. First, a closer look at some of the challenges facing the coffee industry long term. Coffee farmers need some more buzz. Prices are up 40% since mid-October on deficit concerns, but the industry still suffers from things like overproduction and volatility. Industry consolidation putting a lot of control in the hands of 2 big suppliers, Brazil and Vietnam, and climate change, which can alter how a crop survives, grows, and tastes. Low prices create decades-long boom and bust cycles that are hard and expensive to navigate. Take Brazil. It's the largest grower and shipper of Arabica beans. It's the fancy kind that Starbucks uses. It's run out of supplies for new orders. The crop missed expectations this year because of bad weather, while exports stayed strong. Lower prices and interest rates in Brazil also incentivized farmers to hold beans rather than sell them. The result is a price spike for some buyers. Enter Alix Cafe. This roaster wants to de-commoditize the industry. Do things like long-term supply contracts, so growers have cash to innovate, improve genetics, and renovate plantations. Alix Cafe is also one of many roasters that signed a declaration with the International Coffee Organization, which is exploring a funding vehicle using public and private money to develop sustainable coffee regions and stabilize pricing and production. The market needs a reliable, long-lasting jolt of caffeine. I recently caught up with Andrea Illy and asked him just how much investment is really needed.
It needs to be $1 billion per year in order to create resilience. The problem is how to allow growers to get access to finance.
Yes.
So
what do you do?
You know, cost of money in those producing countries is twice as high as in the consuming countries. And plus they have hurdles to overcome in order to access to credit. The solution is to mobilize institutional funds as well as philanthropic funds and impact investment by simply providing collaterals to the growers' investment. And think as simple as a long-term supply contract between a roaster and a contract can represent sufficient collateral in order to allow the grower to access to finance.
What are roasters going to do? Like, what did the ICO kind of lay out, and what's your role in it?
First of all, I think one of the most important strategy is to direct source coffee from growers. And traders can facilitate, because traders can sell contracts with providing full traceability where the coffee comes from. and intermediating a contract between the roaster and the grower. This is one way to, let's say, have a price fixed on the long term rather than spot, and having a price which can take account the cost of production and not only the spot prices on the stock exchange. This is one tactic, and as I said, this long-term contract can also represent a collateral for financement. Other things could be that we build a fund. We are going to investigate a feasibility study for a fund for coffee sustainability.
Do you need then coffee demand to grow at 2% to make all this worth your while? Like if it drops below that, does that affect how you allocate or how you think about it?
I think that rather than considering the volume increase, it would be important to consider the value increase. So what we really necessary in the market in the future is to avoid to fall once again in this low prices trap. This long-term, 10 years cycle is really detrimental for the industry, and it's basically stupid, because why overproduction if you can better control production and maintaining a stable supply and demand?
Well, what price do you think is the best for you, for investment,
and for growers?
It would be
minimum $1.50 per pound, a price which is really allowing to cover all cost of production.
What's the top? The price that you can sustain?
I think prices should stay between $1.50 to maximum $2 per pound in order to cover all cost of production, to have a decent profit and cash flow for growers so that they can invest in constantly improving their plantation, delivering a quality which is good for the consumer to pay a premium.
That was my interview with Andrea Illy, Cafe Chairman. O Tannenbaum, how expensive are thy branches? Well, this year, your Christmas pine is going to be tremendously more expensive because of a 33% drop in Christmas tree production. And farmers are facing a tough future, namely how they're going to remain profitable as droughts and other weather disasters increase. And that's all bad news for your wallet. Christmas tree prices have more than doubled since 2008. Today, the average price of a tree, $76, according to industry reports. That does it for Bloomberg Commodities Edge. This is Bloomberg.